Howdy, Jacob here. Today we're looking at Datadog, 36.1 billion market cap on 33.2 billion enterprise value in the software industry. They are an observability, operates as an observability and security platform for cloud applications globally. They have been around since 2010 out of New York, New York. So pretty new company and have grown like wildfire over 10 times, about 20 times their revenue from 2017 to 2013, 2023. So absolutely phenomenal. Their gross margin is fantastic at about 80%, high 70s, 80%. Operating margin, they're still trying to find some traction, but I assume they're reinvesting a lot for R&D, which we'll look at in a sec. And return on invested capital is negative or low because, again, no earnings. So pretty hard to have a return on invested capital with your numerator is not positive. And so their research and development is actually the greatest expense that they have of everything. So of the 2.1 billion in the most recent year, 410 million was cost of goods sold, 789 from sales, general and admin, and 962 million dollars for research and development. That is between a 40 and 50% expense on R&D, taking money away from today to hopefully get more in the future. It's an investment for sure, and it's not guaranteed, but it's fantastic when you look at likely getting a higher return and revenue growth when you're reinvesting that much back into yourself and researching to make different ways of making extra revenue, extra profit, extra cash flow. So they have $2.2 billion in short-term investments. They have $330 million in cash, $742 million in long-term debt, no short-term debt. I'm not concerned by this balance sheet whatsoever. Their cash-like products are huge in comparison to interest-bearing debt, so no concern there. Free cash flow production is massive recently, and it looks like it's mostly due to stock-based compensation, but even if you remove stock-based compensation for the last 3 years, 4 years, they've actually would have still had positive free cash flow. And so a hefty amount of investment is going into, or a hefty amount of free cash flow is going into reinvestments. Everything. I mean, everything is either acquisition or reinvestment. They're really trying to grow this company like crazy. So we're going to have to create a story. When you create a story, to me, I think you need a bigger margin of safety, because you're making things up in your head that haven't necessarily came to fruition. And so if we look at making our assumptions here, we can see that their free cash flow has been as high as almost 30% on the margin basis, but their earnings haven't been higher than 2%. And so we're going to have to create a story around what we think those margins can end up as in a 7-year period when it's likely a bit more of a mature company. And so for me, I think growth for the next 7 years could easily be 15% a year over the next 7 years. Free net income margin, maybe 20%. Free cash flow margin, 25%. Maybe that's too conservative. I'm not entirely sure. I'm going to have to get a 17.5% return. Share change, they are issuing shares, which you can see through no share repurchases, all reinvestment, and stock-based compensation, where likely a lot of those shares are going to be converted into, or a lot of those options are going to be converted into shares. And it looks to be almost 2%. Let's go 1.5% increase of shares per year. And then a PE with a 15% growth rate, reinvesting everything. But again, this is at the end of 7 years. Are they a lot more mature? Very likely. Do they have a lot of growth ahead of them? Probably still. I'm sure they do. And so I think a 25 PE seems pretty reasonable to me. And we're saying the company's stock price needs to fall 73% before you get the return we're looking for here. I mean, maybe I'm being a bit conservative. Their revenue has been much greater. So maybe 20% is more realistic. Even then, 63% drop. Maybe I'm being too conservative on the margin side, but again, they haven't made earnings margin. And so, even 25 and 30%, it's going to have to fall 55%. And a 25 PE, I mean, I don't really like to go higher than that, because at the end of 7 years, who knows where this company is going to be. I don't want to assign a frothy price to earnings and price to free cash flow, given that so much can change in a 7-year period. Could it be better than expected? Absolutely. But I'm going to be a bit on the conservative end and say maybe their growth is still 10 to 12% for a couple of years, but I just don't like going higher than 25 and a 17.5 discount rate, given the fact that I'm creating a story. They haven't done these margins. Like, we don't know exactly what's gonna come to fruition. And so for me right now, I think this is as big as I'm willing to go on assumptions based, and it's still gonna have to fall a little bit more than in half before you get the return I look for here. So I'm not too antsy to look more into it, but if it gets closer, I think this could be a massive or a company that gives you massive profits if you buy at the right price. And today, I think your assumptions have to be a bit too frothy, definitely to me in my conservative self, before you get the return I look for here. So I'm going to just wait back until it gets to a price that's more attractive to me. Hope you enjoy the video and have a great rest of your day. Thanks.